Then guys, when you go for the next one, net profit ratio 25% approximately. And the other one guys over here, they have said the answer as 27.18% or maybe 27% approximately. Let's take it as that value, 27% approximately. Or is it 28? 28. Okay, so let's go as 28. Done. Okay, then guys, next one, we have the return on equity. I am getting two answers as 11 and 21. Is it okay, guys? 11%, and the other one, guys, over there should become how much? 21% approximately. Right. Little bit check and see, guys, with these answers, where things are okay with you quickly. Okay, now, guys, with these answers, right? Okay. Right. Now, guys, let's go for the second part of the question. Let's see now what they're asking. Okay, right. Okay, now, guys, over here, what they're asking, required A part. Now, required A part, guys, we have finished 3 marks. Okay, right. Now, let's go for the B part. Right, Roman number 1. Calculate Venus consolidated profit for the year as if the acquisition of Luto had not taken place. Your answer should take account into information provided in notes. Your answer should also recalculate the net profit percentage. Okay, now guys, before we read this, let's quickly go through the paragraph, guys, one more time and see. Okay, first one. Venus Corporation acquired 70% of the equity share of Luto, its only subsidiary, on 1st January 2008. Now, guys, point to note. Look at this. Now, Venus Corporation, single entity. Single entity means what? Only Venus numbers are inside this. Understood? Right. Venus Group consolidated. Consolidated means what, guys? Consolidated means Venus answer is also inside. Luto's answer is also inside this statement of profit and loss. Both people's numbers are there. All okay? Right. Now, guys, look at this. 30th of June 2008, we bought the company on January 2008. How many months subsidiary are we looking at, guys, over here? Very good. It's a 6-month subsidiary that we are looking at over here. Okay, 6 months. Right. On reviewing the consolidated financial statements, Vinicius Jr., the managing director, was disappointed and commented that he expected to see high gross profit due to the receipt of discounted purchases from Luto in the post-acquisition period. He has remarked that the acquisition of Luto has not had a positive impact that he expected. Okay, now, guys, they have given you the numbers. Right. Now, guys, look at this paper. There are 5 adjustments that they are speaking about. Okay, 5 different adjustments. Okay. Now, guys, listen. This is the second requirement of the paper. Now, second requirement of the paper, guys, they are asking you to do something like this. Okay. Now, guys, can you put over there adjusted profit of Venus? Right. Put the heading really that way. Right. Adjusted profit of Venus. Right. Adjusted profit of Venus. Okay. Okay, guys, again, one more time. Can little bit look at this requirement, guys. One more time, look at this value. Calculate Venus Corporation consolidated profit. So consolidated profit means, guys, this one. Now, let me go up, will you? Right now, guys, here can you see consolidated net profit is 9,800. Okay, now, guys, first mark it over here. Right, drafted profit. Okay, start writing it this way. Drafted profit. Okay, what's the answer? Right, 9,800 it seems. Right, mark that one, will you? Right, drafted profit 9,800. Right. Are you guys all okay with that part? Right. Now what they're telling, okay, let's continue the question. Right. As if the acquisition of Luto had not taken place. Okay, now guys, what they're telling you to do is this. Now look at this part, guys. Now there are 5 adjustments in your paper. Now they are telling you to recalculate this answer, assuming Luto is never there. Now 9,800, guys, how did we get the answer? That is Venus and Luto together, no? Now what they're telling is this. Between Venus and Luto, 5 things took place. 5 things means these 5 things. Now they are telling you to adjust. Adjust means you now think Luto is never there. If Luto is not there, take these 5 adjustments and I want you to guys recalculate your profit and show it to me as much as possible. Right, start doing that part, guys. So what you do is you do it this way. You read the question and see, okay, if Luto is not there, what will happen to my 9,800? Will it go up or go down? Start adding and subtracting the numbers. All okay? 5 minutes, right? Start doing this one, guys, as much as possible. Whatever that you can. That's it. Okay, right. Start, will you? So a little bit of a tougher part, right? Okay, just try and see whether you can do this part, guys. The 5 adjustments, can you try to do plus and minus, whatever that you can? Okay, plus and minus. Right, so guys, I'll little bit go for, I'll zoom in, then you all can look at this much better and do it. Okay, right. Start adjusting these 5 points. You just take the number and see if this is not there, what will happen to my profit? Will my profit go up or go down? That's it. Okay. So guys, also take into consideration this how many months subsidiary? 6 months subsidiary, yeah? Right, take that also into consideration. That's the corrected answer, no, Shahla? After doing all the adjustments, is it? Yes, correct, Daniel. Yeah, but Daniel, when you're doing the adjustment, do take the number of months into consideration. Okay, when you're doing the adjustment, do take the number of months into consideration. Just think and see what will happen to the profit. Does it affect the profit by any chance? That's it. Okay. Okay, right. So guys, can you little bit check and see with your answers for this part, the adjustment of profit, right? Okay, now guys, first one they are telling you, okay, right. Luto has recognized a revenue of 5 million, which resulted in a net profit of 2 million. Okay, now guys, first of all, can you tell me, are we going to take the 5 million or are we going to take the 2 million for this adjustment, guys, over here? What should we take? Right? We should take the 2 million. Because why we should take 2 million, guys? Because what are we adjusting? We are adjusting the profit. So only the profit you have to take into consideration. Then what about the 5 million, guys? Listen, that 5 million has been given for another purpose. So first thing, guys, what you should do, you should mark it over here, profit. Guys, now think, if Luto is not there, will we get that 2 million profit? No. So therefore, guys, what you should do from this drafted profit, guys, you have to now remove this 2 million. Okay, right. Can you guys remove this 2 million over there, please? Okay, right. So we have to remove 2 million rupees. Done. That's it. Okay, guys, let's go for the next one now. Since the acquisition, Venus is able to buy goods from Luto and there is a saving of 500,000. Now, guys, think, if no, we don't need to take away the 5 million from revenue, because from that revenue, the profit is 2 million. That revenue has been given for another purpose. Okay. Right, guys, second paragraph. When we buy goods from Luto, we are saving 500,000. Okay. Now, when Luto is not there, will we be saving that one? No. Then, guys, if we don't save, profit will go up or go down? It should go down. No, it has to go down, because, guys, we are saving. No, if it's not there, we can't save. So therefore, guys, what you should do, that discount, right, you have to remove from this one another 500. That's it. Done. All good, right? Guys, let's go for the next one now. The consideration of acquisition consisted of a share exchange and an additional 5 million to be paid on 1st of January 2009. Okay, now guys, look at this part. 1st of January 2009, we have to pay 5 million. What do we call this in accounting, guys? If we have to pay in the future, what is this called in accounting? Deferred consideration. Exactly, right? We call it as a deferred consideration. So normally, guys, when there is a deferred consideration, you have to do two things. Okay, right. Right. So, guys, what are the two things that you have to do, guys, when it comes to deferred consideration? First thing, what you have to do, find what value? Find present value. How to find present value? Take the future value and multiply with what? Discounting factor. Okay, now, guys, look at the question one more time. In the future, how much we have to pay? 5 million. Okay, read the paragraph and say, guys, what's the discounting factor they have given? 0.926, is it? 0.926. Yeah. Now, guys, first multiply this and see what's the answer we are getting in that case. 4,630. Good. Guys, listen. Present value will not affect the profit. You know why? Present value, we normally take it to SOFP. So it doesn't affect the profit. Right. Now, guys, step 2. After we define the present value, what is the second thing, guys, we do? Unwinding the discount. Exactly. So, guys, how to unwind discount? Take the present value and multiply by percentage. Correct. Okay. Right. So, guys, what's the present value now? 4,630. What's the percentage? 8. But, guys, you have to be careful. How many months subsidiary are we looking at over here? 6 months. Because, guys, now when you do this part, you get the answer for 1 year. Right? But the subsidiary is not for 1 year, no, guys. Subsidiary is only for 6 months. So therefore, you have to see this one into 6/12. Right? Check and see, guys, and what will be the answer in that case? 185.2. So, guys, shall we take it as 185? Okay. Let's take it as 185 approximately. Because I believe in this question, they are telling, take the numbers to the nearest whole number, I believe. Have they said something like that? No, right? But anyway, guys, let's go as how much, guys? 185, right? So 185, guys, should be the answer. Okay. Guys, now think of this as what? Interest. Okay. Basically, guys, unwinding of discount is what? Interest. Okay. Right. Now, guys, can you go back to your profit calculation? Guys, now think and tell me, if Luto is not there, will this interest be there? No. So should I add to my profit or subtract from the profit? Add to the profit. Very good. Right. Start marking, guys, over here. Right. Unwinding of discount. Right. Unwinding of discount, right? So it's like interest, no guys, interest is normally what? Expenses, right? Right, minus 185, sorry, plus 185, right? Because I have to now add back to my profits. Okay. Are we guys all okay with that part? Right. Then guys, let's go back to the next adjustment, what they are telling. Okay. Right. Guys, adjustment number 4. Can you guys calculate depreciation for me faster? Okay. Adjustment number 4. Please calculate and give me now depreciation. Right. Guys, we have to calculate depreciation for how many months in that case? Only for 6 months. Only for 6 months, you have to calculate depreciation. Okay, start doing that part, guys, for me. Calculate depreciation for 6 months. Okay. Guys, how to calculate depreciation? Look at the paragraph. How much has the fair value gone up by? 900. How many years? 3. So 900 divided by 3. But that's the answer for 1 year. Are we doing for 1 year? No, only for how much, guys? 6 months. So then that answer you have to see into 6 over 12. So what you will be getting, guys? 150. Now 150 is what, guys? Depreciation. Now if Luto is not there, will we be having this depreciation? No. So the profit then, guys, should go up or go down. It has to go up. Profit has to go up, right? So guys, mark that one. Depreciation, what's the answer? Positive 150. You have to add back 150. Okay, you have to add back 150. Okay, that's it, guys. Now, guys, can you quickly adjust and give me, guys, the corrected profit now faster? Right, please check and see now what's going to be the corrected profit. Right. So, guys, please correct and see, guys, the profit. How much is it going to be in that case? 9,800 minus 2,000 minus 500 plus 185 plus 150. How much, guys? 7,635. Yeah, 7,635 should be the answer. Okay. Guys, now listen, this question is not yet done. Okay, guys, look at this part. Now what they are asking, okay. Your answer should also recalculate the net profit percentage. Okay. Now they are asking for Venus group. Again, calculate what? The net profit percentage, right? Now, guys, another one time, let's start calculating that part over there, right? So put there net profit percentage. Okay. Another one time, we have to calculate this one, right? Net profit percentage. Okay, let's calculate net profit percentage another one time. Okay. Right. So, guys, normally net profit percentage, guys, what's the equation? Equation will be profit divided by revenue into 100. Okay. Profit divided by revenue into 100. Okay. Guys, now you should take what profit? The old one or the corrected one? The corrected one. Now you should take the corrected one. Understood, guys? Okay. What's the corrected profit, guys? Now 7,635. The answer that you got. Okay. 7,635. Okay. Guys, now listen carefully. Divided by revenue. No? For the revenue, now there is a small adjustment that you have to do. Okay, now guys, can you do the adjustment and show it to me by referring adjustment number one more time? Okay, now the revenue is 39 million. But in adjustment number 1, there is a small thing that you have to do. Can you guys adjust and now mark it faster? Yeah, very good, Basil, right? Okay, can you adjust and now mark it over there? Exactly, that should be the revenue. Guys, now see, total revenue is 39. But inside this, how much from Luto? 5 million. So if Luto is not there, guys, will we have that 5 million? No, we won't. So therefore, guys, the adjusted revenue has to be very good. 34 million. Right now, guys, can you find the answer, please? No, because they are asking you to take what you can say. And remember, The single entity is for 2007. The consolidated one is for 2008. They are asking you to recalculate the consolidated one. Okay. Right. So guys, I'm getting the answer as 22.456%. Correct? No, guys, that has to be the answer, right? 22.456%. Okay, all good, guys. So with that one, now we have done that part also. Okay, right. Now, guys, let's see what is the next question they're asking from you. Okay. Explain why consolidated financial statements are not comparable to those of the single entity, for example, Venus Corporation, right? Guys, now they are asking from you a very basic question, right? What is the basic question? They are asking, why can't you directly compare a single entity with a consolidated financial statement? Why can't you directly compare? Right? Can you guys start writing for me reasons this way, guys, faster? Okay. Can you write and give me a few reasons why we can't compare single entity with consolidated financial statements? They're asking some reasons. Okay. Can you guys start writing for me why you can't compare directly that way? Okay. Right now, guys, when it comes to income statement, what's the main problem that we have in comparing single entity with consolidated financial statements? Income statement, what's the main problem? Single entity has only whose numbers, guys? Only parent. Consolidated will have parent and subsidiary. Very good, right? So first write that answer, will you guys over there, right? Why can't we compare, right? So first write that as the reason why we can't compare individual financial statements with consolidated financial statements. So start writing this way. First start writing with income statement. Okay. Single income statement will only include parents' income and expenses. Okay. Consolidated income statement will include both parent and subsidiaries' income and expenses. Right. First write that one. Yeah. Why can't we compare directly that way? That means, Amjad, what's the meaning of that sentence? Yeah, correct. Yeah, so they are asking why we can't compare a single entity with a consolidation. What is the reason why we can't compare? Even if you go to compare subsidiaries, individual income statement with consolidation, same problem, no, right? Because consolidation will have two people's answers, while individual income statement will have only one. Yeah, because here they are asking Venus Corporation. That's why I'm answering according to the question. Okay. Right. Okay, now guys, income statement, now you all have what you can say, guys, explained about that. What you have explained, right? When it comes to single income statement, we only have one person's income and expenses. Consolidation will have parent and subsidiary both. That's the problem with guys income statement, no? Right. How about guys problem with SOFP? In SOFP, what is the problem that we have? Now, when you take Venus SOFP will only have what? Venus's assets, liabilities, and equity. But guys, when you take consolidation, what are the problems that we have? We have both whose and whose one? Parent and subsidiary. When it comes to guys SOFP, consolidation, assets and liabilities will have both Venus and Luto. That's one issue. Right? Equity. Right? Equity, guys, will only have whose equity in that case? Now, normally, guys, consolidation and individual income statement will only have whose equity involved? Only parents' equity only. But there can be some more items that are coming. Now, for an example, guys, if you take consolidated SOFP, you have extra things like goodwill, NCI. Now, normally when it comes to the individual SOFP, do you see those items? No, those are not there, right? So these are some other problems that we can face. So two problems. What are two problems? Problem number one, individual SOFP will only have Venus's assets, liabilities, and equity. But consolidated SOFP will have Venus and Luto's assets and liabilities. Equity, you will have parent's equity plus post-acquisition reserve. And also other items like NCI, goodwill will be there in the consolidated SOFP, but not inside the individual SOFP. Right? Can you guys start writing those points also, guys, faster over there? Right? 2 points. Huh? Right. Start writing those. Anyway, I also will write the answer over here. So you start writing the new points regarding SOFP. Right? So start writing, right? When it comes to income statement, right? Venus Co will only include Venus income and expenses, whereas the consolidated income statement will include both Venus and Luto income and expenses. Okay. Yeah, that also we can add, but usually the down part of the profit we normally don't take when it comes to ratios. Okay, right. Then guys, next one, when it comes to SOFP, right? Venus Corporation, right, only includes its own assets, liability, and equity, right? Whereas the consolidated SOFP includes assets and liabilities of both Venus and Luto, while the equity consists of post-acquisition reserves. Right. Then guys, we can also add also the consolidated SOFP includes, right, goodwill and NCI, which is not present in individual SOFP. Okay. Right. Okay, right. Guys, there's another one point that we have to discuss on. Can you guys tell me another one big problem that we have when you compare individual with consolidation? Think and say, guys, carefully. Okay. Can little bit think and tell me another one major problem that we have when it comes to an individual financial statements and a consolidated financial statements. Okay. Right. Yes, very good, Sahla. That's the correct answer. Okay. How about the others, guys? Can little bit think and let me know. What is the major problem that we have? Yes, Amjad, it's kind of connected to that. What do we call those transactions as? Okay. Exactly. Very good, guys. So Basil, Amjad, Rishma, now you have got it correct, guys. Intra-group transactions. Right? Now, guys, you need to understand a small thing. In the individual financial statement, intra-group transactions are there. But when we do consolidation, what do we normally do with intra-group transaction, guys? Do we keep them? No, what do? We always eliminate them. So in the individual financial statement, it will be there, but not inside the consolidated financial statement. Good. Okay, right. So start writing, guys, the last reason over there. Right. The individual financial statements, the individual financial statements includes intra-group transactions. Whereas the consolidated financial statements excludes all intra-group transactions. Right. Right. So guys, with that one, now we have now finished off the 3 markers. So far, guys, we have explained about 11 marks in the paper, right? Okay. Right. Right. All are guys okay with that part? Right. Now, guys, can look at the last part. Based on your answers to part A and B, comment on the comparative performance of Venus Corporation for the year 2007 and 2008, specifically addressing the manager's director's comment. Now, guys, this managing director made 2 comments. What are the 2 comments that he has made? Right? Can you guys little bit go through and see one more time, guys? 2 comments what he has made. One is he is disappointed regarding the gross profit ratio. Okay. Because he thought when we get discounted purchases from Luto, the gross profit will improve. Second thing, guys, he is also making a comment telling that the Luto has not been a positive impact on our business organization. So 2 comments he is making. When we buy on discounts, it has not improved our gross profit. And buying Luto has been a bad impact to us, meaning it has not improved. So 2 comments he is telling that way. Okay. Right. Guys, first of all, can you quickly give a comment about the gross profit ratio, guys, over these 2 years faster? So now they're asking you to comment Venus Corporation with Venus Group. Okay, right. Start writing the comment, guys, about the gross profit ratio faster. Right. Comment about these two quickly. First, tell whether it has increased or decreased. Will you start off that way? Right. Right. First, tell whether they have increased or decreased. Okay, right. So, guys, it's very obvious now. Venus Corporation to Venus Group, 2007 to 2008. What has, guys, actually happened to the ratio? It has reduced. It has reduced by 2%. Okay, so let's start writing that one. Will you guys over there? Okay, so let's mark over there, right? Right, evaluation. Okay, right. Okay, let's start marking, right? Right. Venus Corporation gross profit has fallen by 2% when compared to the consolidated, consolidated gross profit margin. Okay, right. Okay, but guys, can you tell me, I am directly comparing that way, is it actually fair? Right. Now I am telling 2007 gross profit has fallen down by 2%. Is it, guys, actually fair the way that I'm comparing? No. Why? 2007 is only whose answers? Venus. 2008 is whom? Venus and Luto. Guys, now can you do me a small work? Can you calculate and show me gross profit margin without Luto first? Okay. I want you to calculate and show me gross profit margin without Luto. Start calculating that one, guys, quickly. Okay. Without Luto, I want you to calculate and show me the gross profit margin. Okay, right. Now I want you to recalculate gross profit, right? Though the paper is not asking, can you recalculate, because then only we can make a proper comparison, right? Okay, calculate that on video. Right. Guys, can you tell me inside this revenue, how much is given by Luto? 5 million, no? Can you guys remember? 5 million was given by Luto. Okay, now calculate and show it to me, guys, over there. Exactly. 5 million was given by Luto. Okay, but now guys, when you recalculate the gross profit margin, guys, what's actually going to happen, right? So it's going to be this way. 39 million, we have to guys subtract the 5 million, correct or wrong? Because that is from Luto. Okay, so if I remove Luto, guys, what's going to happen? My revenue is going to be how much? 34 million. Okay, now guys, let's start calculating gross profit. Guys, how do we calculate gross profit margin? First, take gross profit. Gross profit should be 7,500. Is that clear? Okay, because guys, understand, when you remove the profit by 5, sorry, my bad. When you remove the revenue by 5 million, what's going to happen to the gross profit? Gross profit should also fall. That also should fall down by 5 million. You understand? Guys, simple accounting. No? When revenue goes down, gross profit also should go down. Okay, so gross profit, guys, will now be 7.5 million divided by how much? 34 million into 100%. Now, guys, can let me know what's going to be the correct answer in that case? Okay, very good, Basil. The answer is how much, guys? 22%. Correct or wrong, guys? The answer is actually going to be 22%. Okay. No, that means, Amjad, the purchasing cost is 3 million. So when you remove 3 from that, automatically the answer will be the same. Okay. Right. So revenue goes down by 5. Cost of sale also should go down by, in that case, how much? The 3 million. No, but here they have said that these people have sold off all the inventories. No, if I'm not wrong. Guys, wait, when it comes to gross profit, wait, let me check and see, have I made a mistake over there? Wait. Okay. 39 million goes down by this. Cost of sale is 26,500. That goes down by 3. $39 million. Wait, Yeah, I think guys, for cost of sale, we have to do a lot of adjustments, no, over there, rather than directly taking it as 26,500. Okay. We'll have to do, yeah. The unwinding part normally won't be taken to gross profit, guys. That is normally taken to finance cost. But then on the other hand, guys, we have to do a little bit recalculation for this part. Okay, guys, I made a small mistake with my gross profit. Okay, shall we guys recalculate it one more time? Okay. Right. So when I'm recalculating, guys, gross profit, what will happen? It will be this way. Okay. Revenue will be 39 million minus how much, guys? 5 million. That is correct. Okay. So 34 million, guys, will become revenue. Right. Cost of sale, guys, let's recalculate one more time, guys, faster. Okay. Let's calculate cost of sale one more time. Okay. So cost of sale, guys, according to the paper is how much? 26,500. No, first write that down, guys, over there. Okay. First one, 26,500. Okay. Right. Guys, now look at this part. Lotto has recognized a revenue of 5 million, where the net profit is 2 million. Okay. So first thing, guys, now over there, okay, now revenue 5 million we have removed now. So that's not an issue over there. Revenue 5 million should go down. Okay. Right. Now, guys, can you adjust this and show it to me, guys, faster to your cost of sale? Okay. Can you adjust this and show it to your cost of sale? Since we were able to buy goods, okay, this has resulted in a saving of 500,000. Okay. So if Luto is not there, guys, what should happen to my cost of sale, guys, over there regarding the 500,000? It has to increase or decrease by 500,000, guys. If that is not there, it has to increase by 500,000. Okay, add 500,000 to that part, guys. Okay, add 500,000 to that part. Correct. Unwinding, guys, will not affect the cost of sale, but the depreciation will affect the cost of sale. Okay, so remember, guys, in our question, depreciation was how much? 150. No, if that depreciation is not there, guys, what will happen? Cost of sale will go down by 150. Okay, check and see, guys, now over there, right? Cost of sale will go down by 150. Okay. Right. Then, guys, what should be the corrected cost of sale, guys, in that case? It has to be 27,000, 26,850. Yes, no? 26,850. Okay. Now, guys, can you check and see what's the new gross profit in that case? Okay. Right. 34 million minus 26,850. 7,150. No, guys. Yeah, 7,150. Okay. Now, guys, can you recalculate 7,150 divided by 34,000 into 100? 21%. No, yeah, very close to the earlier answer. But anyway, 21% is the answer. Right. Right. Okay. Now, guys, can you see a small thing? Look at now what happened. Right. Now, see, when I take Venus Corporation and Venus Group, it shows our gross profit ratio has only fallen down by 2%. It's very comparable. But now, guys, can you see what's happening over here? When I remove Luto, right? When I remove Luto's impact, what's happening to my gross profit, guys? My gross profit is going to be how much? It's going to be 21%. So it shows that without Luto, our gross profit has been impacted very much. It has fallen down by at least how much? At least 13%. There is a reduction. So, guys, now based on this one, can you tell me that director's comment? Now, director gave a comment telling what? Buying Luto has not been very positive on us. Now, based on this ratio, guys, can you tell me, is that statement true or false? That statement is false, because without Luto's performance, your ratio is not even close, right? It has fallen down by 13%. It means that Venus Corporation is not doing well. They are not making enough margins, or maybe their cost of sale control is not good, right? So the director's statement, what he has said over there, is false, because only because of Luto's answer, your ratio is at least close. Okay, so let's start giving a comment on that part, guys, over there, right? Okay, as calculated above. Okay, now let's start commenting. As calculated above. Right. As calculated above, right. Venus Corporation individual performance in 2000X8 has dropped tremendously. Okay, has dropped tremendously. Right. Due to a decline in revenue. Okay. No, but we can tell actually, guys, revenue has increased, no? Has dropped tremendously, even though revenue has increased by 2 million. Okay. Guys, you understand now, guys, why I'm telling revenue has gone up by 2 million. Earlier, guys, revenue was 32, no? Now revenue is 34. So revenue has actually gone up by 2 million. But, right? But the increase in cost of sale has been much bigger. Okay? The increase in cost of sale has been much bigger. As the gross profit has fallen down by at least by 13%. Okay? It has fallen down by 13%. Next line, guys, you can write only by including Luto's performance, the ratio is close to comparable. Okay. That means 32 is comparable to 34 only if we include whose performance? Subsidiary's performance. Therefore, statement made by the director can be considered as false of Luto's acquisition not being positive to Venus. Okay. Okay, right. Guys, can you also quickly give me a comment on no, we don't need because there aren't any specific reasons to be given over there. No? So we can just tell this and we can finish it off. Okay. Guys, can you tell me the other part, guys, over there? Now, this person, the director, made another one statement. What's the other statement that he made? He's telling that because there were discounts from Venus. Now, can you guys remember in this question, they said something like this. When we are buying products from Venus, we got a discount of how much? 500,000, we got discount. But even with the discount, our gross profit has not improved. What do you guys think about that statement, right? He is telling when we bought goods from Venus, we got a 500,000 discount. But that has not improved our gross profit. What's the reason, guys, behind that one? Can little bit think and let me know. Okay. About that particular statement that he made. Yes, very good, Amjad. That's the correct answer. Yes. Guys, now even when we bought the goods for 500,000 profit, it has not made an impact on our performance. What is the reason, guys? What is the reason, guys? We can tell. There was a 500,000 gain, but that gain does not show in the performance. It's not shown in the consolidated financial statement. What's the reason behind it? Exactly, because it's a transaction. It's a intra-group transaction. It's like this, guys. We did make a 500,000 reduction. But the problem is that that 500,000 will not be there in the consolidated financial statements. Why? Because it's an intra-group transaction. Normally, guys, intra-group transactions, what do we normally do in consolidation? It will be eliminated. It will be removed. So even if there's a 500,000 gain, it won't be represented inside the consolidated statement because it is eliminated. So let's write that one, guys, over there. Right. Right. Regarding, okay, let's start marking that one. Okay, regarding the other statement made by the director on discounts received from a subsidiary during purchasing has not improved the GP margin is again incorrect. Is again incorrect as that is an intra-group transaction. Therefore, it will be eliminated from the statement in 2008. So that's why, guys, that one's impact cannot be seen because that will be eliminated. No, so anything that is eliminated, guys, will not be reflecting on the financial statements, right? So that's why you don't see that. Yeah, you can tell, not that, no. Exactly, but it does benefit the business in the long run, meaning the impact can be seen in the individual financial statements rather than inside the consolidated financial statements for 2008. Yeah. Right. The problem is, this is, guys, the 2007 financial statements, no? So in 2007 financial statement, that benefit will not be there. It will be there in 2008 financial statements only. Okay. Because the purchasing has been done in 2008, no? Right. It will be there in the other financial year. Okay. Right. Okay, guys, on the other hand, can you guys quickly give me a comment about the net profit ratio, guys, faster? Okay, can you please give me a comment about the net profit ratio? Just a normal comment can you give me, guys? Now look at this part. Venus Corporation is 28, Venus Group is 25. Okay, but without Luto, the ratio is how much? 22%. Can you guys quickly give me the reasons why it has dropped over there, guys, faster? Okay, can you start writing the reasons for me, please? So give comment about all three, yeah, from here to here and also from here, right? Okay, start giving that one, guys, over there faster. Just give one comment, because to be very honest, we don't have much evidence, right? So just give one comment, will you guys, over there, right? So overall, guys, what has happened from 2000 Venus Co to Venus Group, guys, it has actually fallen. And even when we remove Luto's performance, it has still fallen. Okay. So the main reasons are like this, guys. Okay. Why has the net profit ratio fallen? What's the main reason? First one, there is a fall in what ratio? There's a fall in the gross profit, because there's a fall in the gross profit ratio that has contributed to the fall in net profit ratio. And to be very honest, guys, I don't find any specific reasons to tell what happened to expenses. So what we can tell is, we can just tell that Venus has a poor control on expenses over the last year. So that's why the net profit ratio has fallen. We can tell something like that. Because, guys, already depreciation, what happened? Depreciation, guys, we have already spoken when it comes to cost of sales, no? Only one thing that we can speak about is what, guys? The additional deferred consideration. Only that we can speak about. Okay, so let's start writing the answer, guys, for that one also. Right. So we can tell over there, right? Right, over the year, right? Over the year, gross profit ratio, sorry, not gross profit ratio, right? Net profit ratio has fallen in both consolidated performance and excluding Luto's performance. Okay, consolidated performance and also excluding Luto's performance. Okay. This could be due to, right, number one, fall in gross profit ratio over the year. Ratio over the year. Yeah. Second one, right, poor control of expenses and also you can tell unwinding of discount, because that's the only additional thing that I see there. Okay, unwinding of discount. All good, guys? Okay, guys, last part, let's start writing over there, ROE. Okay, can you guys tell me 2 reasons on why it has fallen quickly? Okay, return on equity. Okay, can you guys please tell me 2 reasons on why it has fallen when compared to the last year? Yeah. Yes, very good, Daniel. Very good, Amjad. Right. What are the other points, guys, that you can tell apart from those two? Why it has fallen over the year? Yes, very good, Asia. Right. Those are the 3 points. Yes. Yeah, correct, Sazri. That one. Okay. How about you all, guys? What is the reason, guys, why the ROE has fallen over the last year? That is one reason. Correct. Right. What are the other reasons, guys, that we can tell? Yeah, Basil, regarding that, this one, what you had asked me regarding expenses, it cannot be considered as generic. You know why? Can little bit check and see over here and here what has happened, right? Right now, see over here, 21 million to 11 million, our expenses are how much? 10 million. 26 million to 12 million, our expenses are how much in that case? 14 million. So our expenses has actually increased over the last year, right? So it's not a generic comment because our expenses has actually increased from here to here, right? So we have a poor control of expenses. Right. Okay. So guys, ROE. Guys, now normally ROE, guys, what are the 2 things what we have, guys, over there? One is profit, other one is what? Equity. So what has happened to profit, guys? Profit has actually decreased. So that ROE has gone down. What's the other major contribution, guys? Equity has actually increased. Equity has increased, guys, because of these reasons. Number one, can you guys remember in the paper they said when we are buying the subsidiary, how did we buy subsidiary? By going for a share exchange. So equity has gone up, meaning the ROE will fall because denominator is big, no? And also, guys, on the other hand, can you also see last year we don't have NCI, this year we have NCI. So meaning the equity is even more bigger. Because of those reasons only, guys, what has happened? Our ROE has fallen down. All okay, right? Let's quickly, guys, write those, right? So let's summarize it faster, right? ROE, right, has fallen over the year, right, due to, right, the following reasons. Okay. Number one, reduction in profit. So if you want, you can write reduction of profit due to the point stated above. You can tell like that. Okay. Right. Reduction in profit. Right. Increase in equity, as there is a share exchange taking place, and the inclusion of NCI. Okay. Inclusion of NCI. Daniel, normally when fair value increase, we don't take it as a revaluation increase, because normally when fair value increase, we add to property and then we deduct that from goodwill. No, we normally don't take it as a revaluation gain. Because double entries, goodwill account credit, asset account debit. Okay, right. Okay, right. Now, guys, shall we quickly write down the conclusion over there faster? Right, let's quickly write the conclusion over there. Right, conclusion. Right. The overall performance has dropped over the year, not because Luto has been a poor acquisition, right? But mainly due to the drop in the individual performance of Venus. Okay, mainly due to the individual performance of Venus, right? And then, guys, you can tell below this one, right? Right. The benefits of purchasing Luto may be obtained after a few years of acquisition. Okay. Benefits of purchasing Luto may be obtained after a few years of acquisition. Because, guys, now you need to understand, now we have bought Luto and it has been only how many months so far? Only 6 months now. Now, sometimes, guys, when you buy companies, the synergies and benefits that you get from these companies may take a little bit time to realize. Now, just because you go and acquire a company, sometimes the benefits don't come in immediately. No, it may take some time for you to get the benefits. So since it has been only 6 months, okay, so you may need a little bit more time for you to get these synergies. Okay, yeah, exactly. In the long run, you might get these benefits. Right. So, guys, with this one, now we have finished off our first consolidated ratio evaluation. Next week, guys, we will be having 3 classes: Thursday, Friday, and Sunday. So another 3 ratio in consolidation I will be picking up during the next week. Okay, right. Right. Now, guys, let's start another one question, guys, over there. Right. In your exam kit, could you guys please go for this question over here? Gold Corporation. It's a consolidated income statement. Go to that one. And also, guys, there is another one income statement that I have to complete. I did halfway. Okay, right. Can you guys a little bit go to that part, please? Right. Please go to Gold Corporation, a consolidated income statement question. Right. Gold Corporation. Okay. Right. Okay. Now, guys, can all of you all guys take out an Excel sheet this way? Right. Now, can you take out a that one, Rimas, we are going to focus on next week. Next week, 3 classes, we are going to focus on that. Not necessarily, but if you have that with you, it will be easier for you to comment. So sometimes even in the exam, even if they have not asked, if you can calculate, then it will be better. Right. Okay. So, guys, then can you put the heading, guys, over there for me, please? Right. Gold Corporation. Right. Consolidated income statement. Okay. Gold Corporation. Question number, guys, 453. Okay. Right. Gold Corporation. Gold Corporation. 435. Okay. Right. So, guys, start. First, we'll write the format. Okay. Consolidated income statement. Okay. Year ended 30th September 2000 X2. Guys, listen, in this question, okay, now guys, first thing what you should understand is, guys, I think two students had asked me the same question. First thing, guys, remember cash flow will not come as a full question in your exam, right? When you take out the textbook, guys, they have specifically explained that for section C, cash flow will not come as a full question. If cash flow does come for the exam, it will be maximum 5 marker in section B. And guys, those who were there in Thursday class, I gave you all a homework. No, what's the homework question? MIMS Corporation. In that MIMS Corporation, guys, down part, they have actually asked us to prepare investing activity and financing activity. So there, guys, I will be explaining cash flow over there, guys. But apart from that one, guys, there is no point us doing a full cash flow question because it won't come for the exam in section C. Right? If it comes maximum, it will come only 5 marker. That's it. More than that, it won't come. Sometimes it's 3. It won't come at all even. Right? So therefore, that's why, guys, I'm not focusing on that part. Next week in MIMS Corporation question, I'll discuss the cash flow area on how to do. All good? Because it's better, guys, if we invest time on more questions like ratios, because that's a sure thing. Okay? That's the reason. Okay, right. So guys, start writing the format, will you? Right. First one, guys, we have revenue. Right. Then, guys, we have cost of sales. Okay. Right. Then, guys, gross profit. Right. Leave one line. Distribution expenses. Right. And guys, remember March first week also, I will be working with you all. Okay. Until you all sit for the exam, we will be having classes. Right. Okay. Right. Next one, guys, administration expenses. Right. We'll check and see, Basil. If time permits, I will go through that. Okay. Or maybe even I can ask you all what you can say. Let's say, now I thought last October batch, I had done cash flows for them. So if that recording is there, I will share it with you because time is the biggest issue that we have. Are you okay with that? If I can upload the October one and give it to you regarding cash flow, what we did over there? Okay, no, that's fine. Yeah, until you all sit for the exam, guys, I'll be having classes. Okay. Right. Administration expenses. Last one, investment income. Right. Next one, guys. Guys, after investment income, can you guys leave one line? You know why I'm asking you to leave one line? Because there can be associate profits, no, for that. Okay. So leave one line. Next one, guys. Finance cost. Okay. Next one, guys, we have profit before tax. Okay. Then we have over there one half is there. No? So I actually asked them to upload 2 classes, December 1st and December 8th. So that's technically 3 questions. Right. Okay. Next one, guys, income tax expense. Right. Then, guys, we have profit for the year. Profit for the year. Okay. Then, guys, write the other 2 sentences. Profit attributable to. Okay. Don't forget that one. Profit attributable to. Right. First one is whom, guys? Parent. Right. The other one is NCI. Okay. Profit attributable to parent. The other one is NCI. Usually, Amjad, we always write distribution only first before administration nowadays. Okay. Sure, I'll share it with you. Okay. Guys, listen. Apart from that one, guys, in this paper, they are also asking students to calculate goodwill. Okay. Apart from this one, they are also asking to calculate goodwill, right? So, guys, separately, I'm also going to write the goodwill equation. Okay. Right. So, let's mark that one also, guys, over there, goodwill. So, normally, guys, how do we calculate goodwill, guys? First thing we need what? Investment. Okay. What is investment, guys? Basically, consideration. Okay. Investment / consideration. Consideration. And guys, to that, what do we normally add? We add fair value of NCI. Then from that one, guys, normally what do we subtract? net assets at acquisition, which is basically working number 2. So remember guys, because we are doing an income statement, this net assets at acquisition working number 2 separately we have to prepare. Is that clear? Okay. Separately guys, that has to be prepared, right? So that one guys, I'll just mark it over here, right? Working number 2. Okay. What is working number 2? Right. Net assets of subsidiary. Okay. So normally guys, for net assets of subsidiary, what are the normal things that we have? We normally have guys share capital. We also have retained earnings. And also what is the other thing guys that we can have? Fair value adjustments. Both we can have. Okay. Done. Which one, Basil? Which point? And then we have guys over there, goodwill. Right. Okay. Now it's like this. Now, normally when you do SOFP, working number 1 is group structure, working number 2, net assets of subsidiary, no. But when we do income statement, the working number 2, the net assets of subsidiary separately, we are not preparing, no. Okay. Because when we do income statement, we just start working number 1 group structure, working number 2 NCI profit, and we start the question. The net assets of subsidiary working, we normally don't do when it comes to income statement, but we do when it comes to SOFP. That's why separately we are doing that part. Are you okay with that? Why we are separately doing that? Yeah. Okay. And also guys, on the other hand, can you also keep ready for me which equation, right? The net profit of NCI. Okay. NCI profit working. Right. So normally guys, NCI profit working, how does it go? Profit after tax of subsidiary, then minus fair value depreciation, minus URP. That is when who is the seller? When subsidiary of parent guys, who has to be seller in this case? Subsidiary, no? Subsidiary only has to be seller. Okay, when S is seller. Correct. Okay, and also guys, on the other hand, who is the next person? We also have minus impairment. Okay, minus impairment. Done. So this will be adjusted profit. Done. Right. Can you guys please keep all of these ready for me? Okay, please keep all of these ready. Sure. 1 minute. Okay. Guys, now can you do me a small work? Now, once you have guys set up everything, okay. Can you guys mark and show me the group structure? And also guys, can you copy down these numbers and show it faster? Because normally when you do income statement, what's the approach? First, you should do working number 1. What is working number 1? Group structure. Show who bought whom, what percentage, how many months. Once you do that, what is the second step that you should do, guys? You have to copy all these numbers, okay? All these numbers that you see, right? You need to, what you can say, copy it and show. All okay, right? Can you guys do that part first of all for me, guys, faster? Draw the structure and also mark and show me all the numbers. Do working number 1 and copy the numbers. 1 minute, right here. Okay, start, will you? Once you do that part, I will show the answer and then let's go for the break. And after the break, let's continue the question. Okay, right. Finish it off, guys, this part over here quickly. Please do and show working number 1. Yeah, okay. So guys, let's start off with guys over here, working number 1. So guys, I'll do it on the side. Huh? Okay. Now guys, how does this question go? Working number 1, what happened, right? It says G acquired 90% of S. That means guys, there is a how much percent NCI? There is a 10% NCI. And also guys, how many months subsidiary? This is a 9-month subsidiary. Correct or wrong guys? Okay, it's a 9-month subsidiary because guys, see, they bought the company on January 2000. Question is for September 2000. So this will become exactly a 9-month subsidiary. Now, once you understand the group structure, okay, you just have to do it this way. Who bought whom? NCI is how much? How many months? Once you do that part, now guys, I want you to start copying the format. Okay, so let's start copying guys. 103,360 parent plus 60,800 subsidiary into 9/12. Guys, once you find the number of months, subsidiaries, income and expenses, you have to show how many months. Okay. Right. Next part, guys, we have cost of sale. So cost of sale, how does it work? 81,920 plus 41,600 into 9 divided by 12. Gross profit, you should not copy. Okay. Right. Distribution expenses, copy that one, guys, over there. 2,560 plus 2,980 into 9 divided by 12. Administration expenses, copy that please. 6080 plus 3740 into 9 divided by 12. Okay, investment income, only parent, no, copy 800. Finance cost, only one person, copy that 672. Profit before tax, please don't copy. Tax, we have to copy. 4,480 plus 2,560 into 9, divide the whole thing by 12. Okay, profit for the year, no need to copy. Okay, no? Right. Okay, right. So guys, once you're done this part, guys, now you all can go for a half an hour break, come back at 11. At 11, guys, we will then continue this question. Okay, right. Can you guys go for a break and come back then? That's it. Right. So guys, I'll share the question to the group as well. Let's continue the question. Okay. Guys, I'll give you 5 minutes time. From this particular paragraph, whatever that you can mark, can you guys start doing that one quickly? Okay. Please read the first paragraph. Okay. Whatever that you can mark, can you start marking faster? Either in the income statement or maybe the goodwill working, whatever that you can mark, guys, can you start marking it over there faster? I'll share the question now to the groups. So from this paragraph, guys, there are, in my opinion, three things that you have to mark. Okay, there are, guys, three things that you have to mark. Okay, can you guys please check and mark on that one properly? Hmm, 1 minute, Daniel. Okay. Yeah, that's correct. That's the answer for the deferred consideration. As in this question, we have to round off the answers to the nearest 1,000. Okay, all your answers, guys, you have to round off for the nearest 1,000. Okay, right. So, guys, you all mark the numbers from first paragraph. Okay, whatever that you can. There are three things that you have to mark. Can you guys mark and show me those three things? Yeah, exactly. Correct. Okay, right. So guys, done with that part. Can little bit check and see your answers. Right. First one, guys, they are telling on 1st of January, gold acquired 90% of the 16 million $1 equity share by issuing 3 shares for every 5 shares. So this is what we call, guys, a share exchange. Now, normally the share exchange is there, no, guys. That is something that I need for my goodwill working. Okay, so let's check and see, guys. Did you all do that part, guys, properly over here? So I'll write here the answer as what? Share exchange. Okay, right. Now, guys, check and see, were you able to, what you can say, guys, work out the correct answer and take. Okay, now what they are telling, gold has acquired 90% of, okay, 90% of 16 million shares, 16,000. Okay, by issuing 3 new shares for every 5 shares acquired. Okay, so 3 for every 5. So multiply by 3 and divide that one by 5. Okay. Then, guys, on the other hand, what you should understand is that now when you do this part, you get the number of shares. Now, we don't want the number of shares, no, guys. What do we want? We want the value of shares. So the value of share will be, you have to multiply this answer by 8. Always remember, guys, who is doing the share exchange? The parent. So you have to, guys, always multiply it by the parent share value, which is going to be 8. This is the first thing, guys, that you have to do, right? Little bit check and see, guys, over there. Is your answer okay with that part? Right, 90% into 16,000 into 3 and divided by 5. Okay, what will be the answer then? Is it, guys, and that into 8? Is it, guys, 69,120? The answer for share exchange. It will be check and see, guys, is that answer correct? 69,120. Yes, no, guys, that's the answer, right? So, guys, I'll mark it over here then. Share exchange answer 69,120. Okay. Yes, that's correct. No, right. Okay, super. Right now, guys, in that paragraph, they are also telling, additionally, Gold Corporation will pay a further consideration on 31st of December 2002. Guys, now see, when are we buying the company? January 2002. Now we are going to pay this in December 2002, which is, guys, after how many years? 1 year. So this is what we call, guys, what consideration? Deferred consideration, right? Let's start calculating that one, guys, over there. Right, deferred consideration. Okay, now, guys, read the question carefully. What they are telling. Gold Corporation will pay 2.42 per share acquired. Now, again, how much have we acquired? 90%. 90% of how many shares? 16,000. And, guys, we are planning to pay for those people how much? Right? 2.42 per share acquired. Okay, 2.42. But, guys, you have to understand, now when you multiply by 2.42, what do you get? Future value. Normally, guys, in share exchange, sorry, my bad. In deferred consideration, we should always mark what value? Present value. So therefore, multiply with the discounting factor. Discounting factor, guys, they have given. Guys, I have always said you, new syllabus papers, discounting factor, they will always give. So it's 10%, which is 0.9091. So multiply, guys, into 0.9091. This is your answer. Okay. Can you guys quickly multiply and take this one, please? Okay. Right. Please multiply and take. Yeah, that's the correct answer. Good. Okay. So, guys, what's the answer? 31,680. Are we, guys, okay with that answer? It will be check and see. All good. 31,680. Okay, so I'll mark that one, guys, over here. Deferred consideration, 31,680. Done. Right. Now, that is the second thing, guys, that you have to do. Okay, first find the share exchange, then find the deferred consideration. Now, guys, you know how things work. Normally, once we find the present value, what is the second thing, guys, that we should do? We should start unwinding. Now, guys, start unwinding that discount faster. Okay, please start unwinding. But, guys, when you start unwinding, please be careful with the number of months. Okay, right, start unwinding, will you? Okay, right. Please unwind and check and see what is going to be the number of months. 16,000 into 90%, that into 2.42, that into 0.9091. 31,680. Yeah, that's okay. And guys, 31,000 now 680. You should do the unwinding part. Okay, guys, I'll show it over here. Right now, guys, normally how do we do the unwinding part? We always do it like this, right? Unwinding, right? Right. We first take what value, guys? Present value. What's the present value? 31,680 into how much percentage? 10%. But guys, you have to always be careful. We should do the unwinding according to the number of months of subsidiary. How many months subsidiary, guys, are we looking at over here? Only 9 months. So this into 9 divided by 12. Okay. Please check and see, guys, what will be the answer in that case. Into 10%, that into 9 divided by 12. So guys, I'm getting the answer as 2,376. This should be the answer. Okay. 2,376. Okay. Guys, now can you tell me this answer normally in the income statement where we should go and mark this one? Very good. Next to finance expenses. Right now, guys, can you go and add this to finance expenses, please? Okay. Go to finance expenses and add 2,376. This is the maximum that you should do when it comes to the first paragraph. Three things: share exchange, deferred consideration, present value, and unwinding. More than that, I do not see any other adjustment that I have to mark. That's it. Okay, right. Guys, now can you go for the first adjustment now of the paper? Right now, go through that one, please. Right. On 1st of October, retained earnings were 56 million. Now, guys, understand. Silver is whom? Silver is whom? The subsidiary. Now, guys, you have to be careful. Don't make a mistake. Subsidiaries retained earnings, they have given for 1st of October. Right now, guys, what's the purpose of this sentence? Why they have given this sentence? To calculate what? Now, they have given the retained earnings in October. Why they have given the retained earnings in October? For what purpose, guys? Right? There has to be a reason why they're giving this answer, right? Exactly. Very good. For what working, guys, we need this answer? For working number 2, we need, guys, the answer for this particular working. Here, can you see? Working number 2, net assets of subsidiary at the acquisition date. Very good. For goodwill, yes. But be careful. Guys, look at this. This is the retained earnings for October. When are we buying this organization? On January. So I want you to now calculate and show me for January, what's the retained earning? Because I need that answer for working number 2. I don't want the retained earnings on October. I want to know what's the retained earning on January. Okay. Now, guys, can you start calculating for me retained earnings for January, please? Okay. Now start calculating retained earnings for January. Okay. Start calculating. I'll give you 2 minutes and then I'll explain. Okay. Right. Start, will you? Start calculating retained earnings for January. Yes. Now you add those two and you mark it for working number 2. Yeah, very good, Shafee. That's the correct answer. Because they have given for October, you have to find for January. So check and see January to October, how many months are there, right? According to that, I want you to calculate and give me the answer. Yes, Rifki, that's the answer. Good. Yeah, October, January, 3 months, that part is correct, but that value is the one little bit of an issue. Okay, others guys, now can you check and see whether did you all get the answer? Okay, guys, now look at this part. Now see, the retained earnings are 56,000. That's for January. Now the problem is there is no point of getting the January answer. We want to know what is the retained earnings on when October. Okay, right? We want to know, guys, when it comes to October, what's going to be the sorry. Right. When it comes to January, guys, we want to know what's the retained earning. Now, guys, you have to think. Okay, now we have October now. Right. October, January, how many months are there? 3 months. So what you should do, you have to see for 3 months, how much did the retained earnings change by? For that, what you should do? You should take the subsidiaries profit after tax. Okay. Little bit check and see, guys. I have taught you in this what lesson? Go to the SOFP lesson. In SOFP lesson, there is a topic called mid-year acquisitions. There I have taught you this part. But anyway, now guys, they have given the retained earning starting balance now. So what you should do? You should add what? Profit after tax into number of months. So whose profit after tax you have to take? Subsidiaries profit after tax, because we are doing the subsidiary calculation. So what you should do now? Take 56,000. To this one, guys, now you have to add how much? 9,920 into 3/12. Subsidiaries profit is there, no, guys? That one you should now check and see 3/12. Why 3/12? Because 56 million is for October. October, November, December. 3 months I have to go front. Okay. Now, guys, check and see once you do this part, what will be the answer in that case? So students have given me the answer as 58,840. This should be the retained earnings at the acquisition date. Okay. And also, guys, I forgot to do a small thing. Guys, can you also mark and show for me what is the share capital of the subsidiary, guys? First, mark that also quickly. Okay. Can you please mark and show what is the share capital of our subsidiary as well? Yeah, read the first paragraph and guys, can you mark and show me share capital of subsidiary? Okay, please read the first paragraph and mark and show me the share capital of subsidiary. Okay, mark that one also. Right, read this paragraph and guys, mark and show me share capital of subsidiary. Correct, that's the answer. How much, guys? 58,480, no? Okay. In it, 58,480. Yeah, I'll explain that one, Daniel. Okay, right. Right. Share capital of subsidiary. Okay. Guys, now when you read the first paragraph, now forget everything. Subsidiary has how many shares in their company? They have how many shares, guys? 16 million shares they have. You have to take the entire thing. Okay. Now, when it comes to share capital, it's not about what we bought and what we didn't buy. It's about how much they have. How many shares, guys, they have in total? 16 million shares. Is that clear? Right. Guys, remember, in accounting, share capital, you should always show it at what value? Nominal value. Now read that sentence and see, guys, what's the nominal value of a share? $1. So therefore, guys, 16,000 into 1, their share capital is 16,000 rupees. That's it. Okay, their share capital is 16,000 rupees. Correct. Okay. Guys, now can you go for the second paragraph? I want you to mark and show me how many numbers. 3 numbers. Start marking that one, guys, over there. In your second paragraph, there are 3 numbers you have to mark and show. 3 numbers means goodwill and income statement, both. 3 values you have to mark and show, right? Start marking over there, 3 values. Okay. Daniel, that part, what you had asked me to explain, it's like this. Okay. Now see, you want the retained earnings at acquisition date now. So first of all, you have to check and see what type of retained earning has been given to me. Can you tell me in the paper, subsidiaries retained earnings, what retained earning has been given to me? Is it the brought forward or is it the carried down? What type of retained earning have they given to me? Exactly. So when you have been given the retained earning brought forward, this is the equation what you have to use. Retained earning brought forward plus profit after tax into number of months. So retained earning brought forward is 56 million. That's for October. No? Now I should understand what's the answer for January. So what I have to do, take the profit after tax. Whose profit? Subsidiaries profit only I have to take. Right? Not parents' profit, because we are trying to calculate subsidiaries retained earnings at the acquisition date. And multiply this one with 3 over 12. Why 3 over 12? Because we have to go forward 3 months. Because see, 56,000 is for October. No? We want to go for January. So October to January, 3 months now we have to travel front. That's why 3 over 12 has been taken. Which one? No, I think what you are doing is you're seeing 56,000 into 3 over 12. That's wrong. You have to see 9,920 into 3 over 12. Can't be. No. Okay, okay. So, no. First, what you should do is 9,920 you have to see into 3 over 12. That you have to add to 56,000. I think you have added that and then see. Yeah, exactly. Bit mess. Okay, no? Yeah. Because the 56,000, you can't do 3 over 12, no? Because that's the entire retained earnings on January. Okay, so for that, you can't do. Okay, right. Others, guys, now can you work on second adjustment, guys, for me? See whether did you mark 3 things. Okay, start marking, guys, over there. See whether did you mark 3 numbers. What are 3 numbers? 2.6 million, 850, and also what's the other one? The depreciation. Make sure, guys, 3 numbers you have marked and show. Right. Yes. Rifki, little bit check on your depreciation answer. Little bit check on the depreciation answer. Yeah, I think that should be the depreciation answer. Guys, Shafee, Daniel, both what you have sent, I think that should be the one. Yes, Asiya answer is correct. Good. All okay, guys. Shall we discuss and see the question? Okay, guys. First one, 2.6 million is. No, Daniel, read the question carefully and see. They will tell where to go and mark. Okay, guys. First one, 2.6 million. What do we call that one, guys? That is going to be what adjustment? Fair value adjustment. Where we have to mark that one in working number 2, the net assets of subsidiary, right? First of all, guys, can you make sure you have written it here? Fair value adjustments. What is the name of this adjustment? Plant. Okay, mark that one, guys, over here. What's the answer? 2,600 fair value has gone up. Yes, Rifki, now the answer is correct. Okay. Guys, after you do fair value adjustment, what you should do now? Fair value depreciation. Guys, when calculating depreciation, look at this carefully. 2.6 million divided by how many years? 3. But guys, this question is only for how many months? Only for 9 months. So you have to see into 9 over 12, where the answer will be how much, guys, over there? 650. That should be the answer, guys. Remember, depreciation, you have to always put the subsidiaries number of months, because you know why? This is whose plant? Subsidiaries plant. Therefore, you have to see subsidiary number of months. Okay. So the answer is 650. Where should you go and mark this one? Where does the paper say? You have to mark this to cost of sale. Now, guys, can you go and add this to cost of sale, please? The answer is plus 650. So now we have marked 2 things. 2.6 million and 650. 2 things done. Okay. Right. Okay, guys, now last one. Something new. We have never come across this in papers. Silver had a contingent liability of 850. This is also a fair value adjustment. Okay, now guys, can all of you all go to working number 2 faster? Okay, right, go to working number 2, fair value adjustment. Start writing here. Contingent liability. Okay, right, mark it, guys, over there. Contingent liability. Okay, guys, now think and let me know. Should I add this or subtract this? Think and let me know carefully. What should I do? I have to Subtract, because guys understand, when the asset value is increasing, we are adding to fair value adjustments now. Like that, when the liability value increases from fair value adjustment, we have to subtract. Mark this one, minus 850. Okay. An increase in liabilities will result in a reduction of net assets. Right? Think of it this way. When assets are going up, net assets are going up. No. Likewise, when the liabilities are going up, the net assets will fall down, minus 850. Okay. Guys, has this liability value changed? No. But I'm just telling you one small thing. Listen carefully. If the liability value has changed, that change, you have to mark it inside the income statement and show. Is that clear? Where to mark it inside the income statement? Paper will tell. Now, guys, let's say the contingent liability is 850. Then at the end of the year, it became 900. Then that 50, the change, you have to mark it inside the income statement. Where to mark? They will tell. Now, depreciation, they said no, cost of sale. Like that, they will tell where to go and mark if there is a change. But so far, there has not been changes in papers. Right. Okay. Now, guys, let's go for the next adjustment. Right. Okay. Can you guys read this one faster? It's important for the goodwill. Okay. Read this and see quickly. Third adjustment. Right. Because I have to take it away. That's why. Okay. Read that one, guys, faster. Okay. So what are they telling? Right. NCI should be valued at what value? Fair value by using what? The share price of silver. Okay. So by using the share price of silver, you have to value your NCI. Okay, guys, can you read the first paragraph? Calculate and give me the value of the NCI faster. Fair value of NCI. Okay. Please read the first paragraph and find and give me the fair value of NCI. Okay, start that one. Easy adjustment. Should not take you that long. Good. No, I think Daniel, there's a small mistake, I believe. Yes, very good. Yeah, Sazvi, Basil, both the answers are correct. Right. Guys, how much you all are getting for NCI? Is it 5,600 by any chance? Okay, 5,600 should be the answer. Okay, right. Very good, Devmini. The answer is correct. Okay, guys, others who are not getting the answer, okay, little bit check and see now the working, how to get the fair value of NCI. Guys, look at this one right now. See, when calculating the fair value of NCI, this is how we have to do. Yes, the key answer is correct. Guys, now see, how much percentage is NCI? 10%. 10% of how many shares? 16,000 shares. Done. So that means NCI has 1,600 shares. One share is 3 point how much? 5. Because guys, we have to multiply using the silver share price. No? So silver share price is 3.5. That's it, guys. And then you should be able to get your answer. The answer has to be none other than 5,600. This has to be the answer. No. Normally, that one, Basil, we normally reduce depreciation from the reporting column. Now you have to understand, working number 2, what we do for goodwill is for what column? Acquisition column. Still, we don't reduce the depreciation from the plant because the reduction should be done in the reporting column. For goodwill, we always take the acquisition column. No? So still, we don't reduce it from the plant that way. We have to only reduce it from what column? The reporting column and not the acquisition column. Right. 69,120. And what is the other one over there? Yeah. Because Daniel, understand, NCI has no part to play with the 3/5. Okay. NCI has only 10% of the company. No? So 10% into 16 million into value per share. The 3.5 is share exchange of parent. Okay, then guys, now that part is also done. Okay, guys, now I'm giving for you adjustment number 4. Start doing it, guys, on your own. There are two things that you should work on. Adjustment number 4. What are the two things? Intra-group sale and purchase, URP. Start doing that one, guys, faster. Right? Intra-group sales and purchasers and URP. Okay, right. Please work on that one. Number 4. Yeah, that answer is correct for intra-group sale. That's good. Sahla is correct, but Daniel can little bit check the answer and see one more time. Yes, if key answer is correct, yeah. Now Daniel answer is correct. Right, Krishma, to answer your question, when there is an increase from the reporting column, you have to subtract. Okay, from the reporting column, you have to subtract. Okay, guys, how about you all can little bit check and see, guys. First one, 600,000 per month sale. So what is the first thing, guys? What I have to do? 600,000 I have to multiply by 9 because it's per month. Okay, so first thing what you should do, 600 into 9. What is the answer? 5,400. What do we call this answer? Intra-group sales and purchase. What should we do? Step number 1. Can you all guys go to sales and remove this one? Remove from revenue minus 5,400. Done. All good? Right. Guys, what is the next thing that you should do? Remove from sales and remove from where? Cost of sales. Very good. Remove from cost of sale also quickly. Minus 5,400. Yeah, Rifki, that answer is correct. Okay. Guys, always after we do the intra-group sale and purchase, what is the next thing, guys, that we should do? We should calculate URP. Okay. Now, normally, guys, how do we calculate URP? It is profit into inventory held. How much of inventories are held inside this warehouse? 1,200,000. And guys, remember the profit should be 25 over 125. This should be the profit. Because guys, understand, this is 25% on cost now. But 1.2 million is what? Selling price. Okay, so therefore, guys, remember when you are doing selling price, you have to convert. Okay, that's why I have taken that answer as 25 over 125. Right now, guys, if a student didn't understand why I'm taking 25 over 125, guys, okay, guys, look at this part, will you? Right now, normally in accounting, right, profit is equal to selling price minus cost, no, guys, okay, selling price minus cost. Now, what is the profit that these people are keeping? 25%. 25% on what? Cost. If it's cost means we call that as markup. So markup is always cost is 100%. So if cost is 100, guys, selling price should always be more, no? So selling price has to be 125%. So selling price is 1.2 million. So 1.2 million is represented by 125. That's why 1.2 million divided by 125 into 25 to understand what's the profit. That's how I have gone there. So what's the answer, guys? 240. Good. So when it is 240, guys, what you should do, I have taught you in class, doesn't matter who sells to whom. What you should do in accounting to cost of sale, guys, what you should do, add or subtract. We have to always add, right? You have to add to cost of sale. Right now, guys, can you go and add to cost of sale over there? Plus 240. Yes, we have to remove the NCI share. Correct. Okay. And also, guys, little bit keep in mind who is selling to whom this time. Gold is selling to silver. That means who is selling to whom? Parent is selling to subsidiary. Keep that in mind. Huh? Parent is selling to subsidiary. Okay, guys, next one. Adjustment number 5. Can you guys please read that and see? Right? Adjustment number 5. Exactly. We don't have to remove. Good. Okay, read that part, guys. Okay, what do they say over there? Gold's investment income is a dividend received from a 40% owned associate. Guys, listen. When you receive dividends from associate, what we have to do, you should remove that from the income statement. Now, guys, can all of you go to this investment income faster? Right. This investment income we got from whom? Associate. Remove this one completely. Minus 800. Remove that one. Right now, guys, if you're thinking why we are removing that, guys, listen, when it comes to associate, we are separately showing something called profit share of associate. That's why the dividend from associate is removed. Okay. Now, guys, can you mark here faster below this one? Profit share of associate. Okay. Now mark that one, guys, below the investment income, profit share of associate. So, guys, remember, dividends from subsidiary must remove. Dividends from associate must remove. Okay. Why are we removing dividends from associate? Because for associate, we are showing separately their share of profit. Guys, now can you take out your calculator? Calculate and show me what is the share of profit from associate first, right? Start calculating for me the profit share of associate. Should not take you that long. Yeah, correct. That's the answer. Good. Okay. Guys, what's the profit share of associate? 1,200. Easy now, guys. 3 million profit. We have owned them for several years. 40% we should get. So, guys, show the working if you want. Okay. 3 million. Okay. 3 million into 40%. Okay. Then, guys, what should be the answer? 1,200. That has to be the answer. Right. Show it, guys, over here. 1,200. Done. That's it. Yeah, we are yet to receive the balance 400. Correct. How did we get 800? 800 was given in the question paper. Yeah. Investment income. And the paper says this investment income is what they have got from the associate. Okay. Right. Okay, guys, last part. This has nothing to do with consolidation. Can you guys read this and tell me from what lesson is this coming from? Okay. The adjustment number 6 is nothing to do with consolidation. But can you check and let me know from where is this adjustment coming from? Which lesson? Very good. Okay. Right. Financial instruments. What is the name of this instrument, guys? What do we call this one, guys, over there? It's a convertible loan. We give a name call, guys. What account? What do we call it? What kind of instrument this is? Starts with a C. What kind of instrument, guys? This is called compound instrument. Okay, very good. So, guys, compound instrument. What is the type of accounting that we do? There's a name for it. Okay, what is the type of accounting? Yeah, online students, that's correct. What's the name for accounting, guys? We call it as split accounting. We should do split accounting for this. Okay, so guys, remember, this is coming from the lesson. What lesson? Financial instruments. We call these as compound instruments. Compound instruments, guys, what we should do? We should do split accounting. All okay? Right now, guys, can you start doing this one? We'll do it together because we haven't done financial instruments in a long time. Guys, listen, next Thursday, Friday, Sunday, we are going to do a revision on the standards. How revision? Question-based revision. Section B, I'll be revising. Through that, we'll be discussing the standards. Right now, guys, can you put a separate working for me, guys, faster? Okay, right. Please put a separate working as convertible loan. Put something working number and guys mark it over there. Convertible loan. Okay, right. Mark that one, guys. Let's do it together. Convertible loan. Okay, right. Right. Below this one, guys, can you write step number 1, right? Convertible loan. Step number 1, guys, what we should do, right? Right. Value of loan. Okay, right. Step number 1, guys, what we should do, value of the loan. Okay, right. All okay, right. Now, guys, how do we calculate the value of the loan? This is what, guys, you have to do. Okay, how to calculate the value of the loan? Very good. First one, guys, what we should do, we should find the present value of, okay, present value of cash flow. When we say cash flow, it's about interest and capital. Okay, it's about interest and capital. Present value of cash loan, interest and capital. Okay. All good. Shall we start, guys? Okay. Now, guys, can you read this question and tell me how many year loan are we looking at, guys, over here? Okay. Right. How many year loan, guys, are we looking at, guys, over here? We are looking at a 5-year loan. So, guys, first thing what you should understand for year 1, 2, 3, 4, 5. For 5 years, first we have to pay interest. Okay. So, guys, can you mark it over there? Year 1 to 5. Okay. Year 1 to 5. Right, we have to pay interest. Guys, can you read the paragraph and tell me how much of interest are you going to pay? Simple calculation, okay? Right, please go through the paragraph and guys tell me over there, how much interest are we going to pay? Right, how much interest are we going to pay? Guys, are we going to pay 8% or are we going to pay 6%? We are going to pay 6%. Okay, we have promised 6% now, guys. So in reality, we are only going to pay 6%. Okay, can you guys calculate and show me 6%? What should be the answer? Right. How much is the loan, guys, over there? We have issued 100,000 loans. Okay, right. Take the calculator and see them. Right. 100,000 loans. Okay. Right. One loan is $100. Right. So that's 10 million. So we have promised to pay how much, guys? We have promised to pay 6%. Okay. So 6%, guys, what will be the answer in that case for 10 million? Right. Answer will be 600,000. So therefore, guys, then can you mark here? Interest is 600,000. Done. Okay. Guys, now think and carefully and let me know this management accounting, guys, because for first year to the 5th year, the interest is same. Should I use discounting factor or annuity factor? What should I use? Discounting factor, annuity factor, guys, we have to use the annuity factor. Guys, remember, it's like this. There are 2 ways to do it. First thing you can do year 1, 2, 3, 4, 5. Separately for 5 years, you can multiply and take with discounting factor. But those who have done management accounting or financial management or whatever, you know that when the cash flows are equal to every year, rather than multiplying it 5 times, you can multiply with what factor? Annuity factor you can multiply. But don't rush. Guys, annuity factor, should I take 6% answer or the 8% answer? Which one, guys, we should take? 6% or 8%? What should we take? You'll take the 8% answer. Guys, remember, when you do the discounting factor, you should always discount at what value? Effective rate. Okay, now normally, guys, in this lesson, there will be 2 rates. One is the agreed rate, that is 6%. And also, guys, there will be an effective rate. Always remember, when you calculate present value, you should always calculate at what rate? The effective rate. So therefore, guys, when I take the discounting factor, I should take 8%. What factor? Annuity factor, because year 1 to 5 interest is same. Right. Can you guys now mark it over there? 3.9333. Right. Sorry, 3.993. Okay, Daniel, to answer your question, can little bit read the first paragraph and see when have we issued the loan? Right? This is nothing to do with subsidiary. Okay, when have we issued the loan? Exactly. So is it a 9-month loan or a 1-year loan? Exactly. It's a 1 year loan. That's why we did not take the number of months. Okay, guys, now calculate and show me, guys, what's the answer for the interest part, guys, over there. What's going to be the present value of interest? 2,396. Is that answer correct, guys, over there? Yeah. 2,396. So, guys, first thing what you should do, you should find the present value of interest. That is first thing. Right. And guys, remember, these are what loans? Convertible loans. So guys, please remember, if it's a convertible loan, in the final year, we might have to return the loan back. Now, convertible loan means what? At the last year, the person has an option. Either he will take the loan or he will convert that into shares. If he asks his money back in the 5th year, now guys, start marking with me, year 5, okay? In the 5th year, we have to return the loan. Guys, if you're returning the loan, how much worth of loan are you going to return for that person? We have to return how much of the loan, guys? We should return 10 million worth of loan. How 10 million? Guys, look at this. 100,000 loan. One loan is $100. 10 million I should return. Mark it, guys, over there. 10,000. Right, I should mark 10,000. Guys, now can you tell me, I should take now what factor? Should I take now the annuity factor or the discounting factor? Now we should take what factor? We should take the discounting factor. Why we should take discounting factor? Guys, this is the answer for how many years? It's only for 1 year. When it's for 1 year, you should always take discounting factor. You understand? If it's for many years, then only you should take the annuity factor. So understand, 10,000 is the cash flow for 5th year. So if it's for 5th year, you should only take discounting factor, which is 0.618. Right, mark it, guys, over there. Right. Yeah, Amjad, remember, when we issue a loan, we only should pay the interest, no? Okay, we are issuing the loan means what? We give the document and we take the loan. So we are actually taking a loan over here. Right. Okay, then guys, what will be the answer? 6,810. Guys, now can you add these two answers and let me know what's the final value for the loan? Okay, right. Now, can you add these two and let me know, guys, what's the value of the loan? Right. Yeah, so guys, we are getting how much? 9,260. Guys, start revising financial instruments. Financial instruments are one of the key standards for FR exam. Okay, start revising. Right, so guys, what's the answer then? 9,206. Okay, 1 minute. 6,810 plus 2,396. Yeah, 9,206. Okay, done. Right. Guys, now listen, last part. This is the value of the loan. Is that clear? But remember, this is the value of the loan on 1st of October 2001. Are we doing the financial statements? Okay, yeah, correct. Guys, listen. Now, normally after we find the loan, we should also find what value? Equity value. But I am not finding the equity value because I am not doing the SOFP, you know. So therefore, I am not finding equity value. But normally when I was teaching in theory class, I used to do it like this. I used to take this answer and subtract from 10,000 from the loan. Then we will get what value? The equity share value, convertible share value we will get. But I'm not going to do that. Right now, guys, listen. Once you get the 9,206, that is the answer for when, that is the answer for 1st of January to, sorry, my bad, 1st of October 2001. But the financial statements are prepared when? September 2002. So 1 year has passed. Once you find the value of the loan, to do the calculation for the end of the year, we should do what table? Amortized cost table has to be done. Because end of the day, this is what? A loan, financial liability. Financial liabilities are always held at amortized cost. Right now, guys, below this, write down over here, amortized cost. Okay. Now, marker is over there. Next part, last one, huh? Amortized cost. Okay. Guys, normally, how does the amortized cost table work? Brought forward plus interest minus cash is equal to carried down. Okay. Right, Amjad, to answer your question, you should take 9,206 and subtract from 10,000. Okay. The loan value minus your answer. So the loan is 10,000 minus from 9,206. Then you will get the equity value answer. Right, brought forward plus interest minus cash is equal to carry it down. Okay. Done. Yeah, we have to put the equity shares inside SOFP. So since we are not doing the SOFP, I'm not going to do that part. Okay. You have to mark it inside equity as other components. Now, normally in equity, we have share capital. No? After share capital, we have something called other components of equity. No? There you have to mark that 794 and show. Guys, brought forward, what's the answer? 9,206. First mark that one, 9,206. Guys, don't make a mistake. Interest. Normally, we always charge what interest? Normal rate or effective rate? We should always charge the what rate? Effective rate. In this question, what's the effective rate? How much percentage? 8%. Now, guys, can you charge 8% on this answer and let me know what's the answer? 8% is the effective rate. Yes, on the brought forward, that means on 9,206, guys, now I want you to charge the effective rate, okay? Right, what's the effective rate, guys? 736. Is that correct? Right, 736 is the answer. All good, guys. Right, minus cash. Guys, what is cash? Actual interest paid. How much actually are we paying? 600. Mark there, guys, 600. This one, 600, can you see there? That's 600 only we are paying. Okay. Now, guys, can you get me the carry it down quickly? I'm getting 9,342. Okay. So we are getting 9,342. All okay, guys. Right. Right. Guys, now listen carefully. Right. This 9,342, we normally mark inside non-current liability. That's not what I want. Right. Now listen carefully. Guys, can you see this 736 is there? This 736 is the interest for the current year. We normally mark this inside finance expenses, but don't rush. Look at this question carefully. See what have they done? Right now, guys, look at this. Gold Corporation has recorded the loan at par value. What is the meaning of that one? They have taken the loan as 10,000 without taking it as 9,206 and charged 6% interest into finance cost. Now, guys, for 10,000 loan, when you see 6%, what will be the answer? 600. So 600 they have charged to finance cost. That is wrong, no, guys. Can you see here correctly what is the answer that has to go inside finance cost? 736. That means how much are we short now? 136. Very good, guys. 136. Can you please go and mark it inside finance expenses plus 136. Right. So, guys, remember they have gone and put to finance expense 600. The correct answer is 736. So, we are short. No, go and add the difference inside 136. That's what we have to do. Right. Are we guys all okay with why I added 136, guys? Online students, are you all okay with that part? Or you can do it like this. Add 736, remove 600. End of the day, it's the same. So, with that one, guys, now we are done with the question. Okay. Now, guys, let's start doing this one now. Right. Guys, now can all of you all go to goodwill faster? Right, we'll start with this one, guys, over here. All good now, right? Let's start with goodwill. Okay. Right, guys, can you take your calculator at the share exchange and the deferred exchange and let me know, guys, what's the investment or the consideration, please? Okay, right, add these two faster. The share exchange and the deferred exchange. Please add these two and let me know what's the investment value. 69,120 plus 58,840. Right. What is the total investment? Wait, guys, can you first of all let me know these two answers on the screen? Is it the correct one? Because you know why, guys, I deleted and I wrote it again. Is it the correct answers, guys, what you all wrote? Same as what we wrote earlier. Is it correct? Share exchange and deferred consideration. Are these two answers okay? Now, I think my deferred consideration answer is wrong, no? Yeah, I think it's 31,680. Yeah, 31,680. Yes. Yeah. So therefore, guys, now when we add these two, 69,120 plus 31,680, how much, guys? 100,800. Yeah. Okay, fair value of NCI, all okay. Guys, now working number 2. Can all of you guys now total this up and show it to me? What's the answer for working number 2? Okay, working number 2, net assets of subsidiary. Total it up, please. Right, how much, guys? 76,230 according to 2 students. Is that correct? 76,230 net assets of subsidiary. Correct now? Right. Now, guys, can you copy this to the next page? Next page means, can you copy it over here? 76,230. Right. Mark it, guys, over there. Okay. Guys, now can you get me the goodwill answer faster? Right. Now complete and show me goodwill. Guys, remember one thing. I have seen so many past papers. If it's income statement, they are always asking students to calculate what? Goodwill. Right. So make sure, guys, you practice these two properly. Okay. Right, goodwill. What's the answer? 30,120. Are we guys okay with that? 30,120, the 170. I think 170, no? Right, 30,170. Because 230, no? Yeah, 30,170. So, guys, with this 6 marks finished, goodwill is done. All are guys okay with that? Right. Guys, now can you complete and give me the income statement faster? Okay. Start calculating, guys, for me now. Income statement quickly. Right. Please get me the answer for profit for the year. Right. Start doing that one. Please calculate profit for the year. Okay. Yes. Yeah. Amra, to answer your question, if there is an impairment, it's like this. Now, the first question, what they're asking, goodwill at acquisition date. So normally when you calculate goodwill at acquisition date, you don't have to mark the impairment. But to answer your question, if there is an impairment, that impairment, you have to charge it to where? Income statement. And when you're showing in the SOFP, you have to subtract that impairment and only you have to mark. But when you're calculating goodwill at acquisition date, that time no need to worry about the impairment. But when you're preparing the SOFP, we have to deduct an only mark and also mark the impairment as an expense. All okay? Okay, right. Okay, guys, others can little bit check and see, guys, with the answers where things are okay with you. So from a student, I got the answer as 12,886. Is that answer correct, guys? 12,886. Okay, so seems like, guys, that answer is the correct one. Okay. 103,360 plus 60,800 into 9 divided by 12 minus 5,400. So, guys, I'm getting revenue 143,560. If it's wrong, just let me know. Right, next one, 81,920 plus 41,600 into 9 divided by 12 plus 650 minus 5,400 plus 240. Guys, cost of sale 108, 610. Is that okay? Yeah. Distribution expenses 2560 plus 2980 into 9 divided by 12, 4795. Right. Administration expenses 6080 plus 3740 into 9 divided by 12. I'm getting 8885. Investment income, answer is 0. Finance cost answer 672 plus 2376 plus 136. 3184. Right. Income tax expenses, guys, I'm getting the answer 4480 plus 2560 into 9 divided by 12. 6400. Right. Guys, all are okay with 12,886. Little bit check and see, guys, the answer. Whether is it okay with you all? Right, guys, let's quickly finish off the last part, guys, and let's conclude. Okay, let's finish off the last part now. Okay. Guys, we need to now calculate profit attributable to NCI. So how to do that one? First thing, you go to your question paper. Okay, right. Guys, now in the question paper, when you calculate NCI profit, okay, when you calculate NCI profit, you have to first take subsidiaries profit after tax. All good? When you calculate NCI profit, NCI is the owner of whose company? Subsidiary company, no, guys. So you should first take subsidiaries profit after tax. Right now, guys, start doing this with me. Okay, go to NCI profit working. Right, let's start. Okay, subsidiaries profit after tax, guys. What's the answer? 9,920. If I'm not wrong, let me check one more time. Yeah, 9,920. Right, first mark this one, guys, over there. 9,920. But guys, you have to be careful. Though we take 9,920, it has to be for how many months only? Into 9 over 12, because the 9 months subsidiary now, guys. Okay, so first show this one into 9 divided by 12. Okay, first get this answer into 9 divided by 12. Right, 9,920 into 9 divided by 12. What's the answer? 7,440. Okay, 7,440. Guys, can you tell me in this question, was there a fair value depreciation? Yes or no? Yes. What was the answer? I believe it was 650. Mark that one, guys. Minus 650. Okay. Guys, now don't make a mistake. In our paper, there was a URP, but who was seller in that case? Parent. Gold only sold. If gold is selling or the parent is selling, zero. There is no URP impact. Only when subsidiary is seller, you should take. Last one, did we have, guys, any impairment by any chance? No, zero. Now, guys, can you get me the adjusted profit faster? 7,440 into this. Right. So, guys, 7,440 minus 650, I am getting 6,790. Okay, right. Now, guys, when we get 6,790, we should put how much percentage for this one? 10%, because remember, we are finding NCI share. Okay, so 10%, guys, what will be the answer then? 679. That should be the answer. Okay, 679. Okay, guys, now last part. Can you take 679? Copy this one over here quickly. 679. Okay, right. Guys, this profit, mark it one more time. 12,886. Copy it one more time down here. This answer, copy it down. And now, guys, can you get me what's the parent share quickly? Please find the parent share. Okay. So, guys, what will be the parent share in that case? 12,207. No, yes, that has to be the answer. Done. Right. So, guys, with that, 2 big questions we finished today. 30 mark worth of questions we have completed. So, guys, remember, next week we will be focusing completely on what? Accounting standards. Right? Thursday, Friday, and Sunday. Yeah, 1 minute, Basil. Amjad, wait, let me check your question. That's why now we are adding the URP to the cost of sale to adjust the inventory value. And then from the SOFP, that inventory value will again be removed. Okay, so they are like how you said, their inventory is more by 240. No, so when we are preparing the SOFP, from there we'll remove another 240 from current assets. Better to show the minus sign when you're doing the questions. Okay. Right, guys. Y'all can make a move. That's it for today, guys. Two big questions we did know. That's enough. Again, guys, I'll meet you all then on Thursday for accounting standards. Huh? We'll be revising standards. Yeah, dollar sign Basil, just put on top and keep once. Okay. Right. Right. Okay. Usually, Shanuri, this one they will upload it in the LMS. Do you have access to the LMS by any chance? Yeah, Daniel, you have to what you can say, since you have little bit forgotten, it's better you watch the recordings, but you can speed it up and watch, because remember, without the proper standard knowledge, it will be difficult to do questions, especially financial statements and section AB. So it's not a problem. You go through it one more time. But anyway, next week I'm trying to revise on everything. Everything means majority of the stands I'll be touching tomorrow, next week. So you will be getting a quick recap, but I would recommend you just to go through those recordings also one more time. Yeah. Yeah, they might ask small questions, Basil. There is no guarantee it might come. You have access for the October batch, no? Right. So, Shanuri, what I have requested is all the class recordings to be uploaded for October and December. So, Thursday and Friday recording will be available on your LMS. But those are not uploaded, right? Okay. Anyway, let me drop them a small message telling that anyway, I have requested for them to upload all the recordings. I'll just remind them before I go one more time. Right. All right, guys, welcome then. And also, guys, remember, please go through the standards. Now, next week, target is standards. Okay. We'll be doing one ratio question each day plus accounting standards. That will be the target. Yeah. Next class, guys, again on Thursday, 2 to 6. Okay. All right, guys. See you all then. NCA, Prof.